All right. Well, good afternoon, everyone. This is Scott Thompson, and we are here for lesson number 6 for stock investing for beginners. And want to give a huge shout out to Eva and Sharon and Simone and Will and Jay Richardson and everybody else that's here today. Robert, appreciate you taking some time out of your busy schedule to be here with me today. Fun to chat with a few of you before the class starts, as always. Gary, good to see you. Give a shout out to Brent Morse, who is in the chat today. A good friend of mine and golf buddy. By the way, we need to go golfing again here soon, Brent. Any day we don't lose a ball, that's a good day for us, or me at least. Anyway, today's lesson topic is really fun for me because this is one of the things that I learned just enough about to not take any action at all. This is our topic today's technical analysis, and hopefully today, by the time we're done, you'll be able to number one understand that there's no perfect buy signal, and so or entry point, whether you're doing that fundamentally based or technically based. I've seen what I would consider a perfect entry signal lose money, and I've seen what I would consider a horrible entry based on technical analysis be just fine. Today, ultimately, the goal is to help you learn some technical analysis, help you identify what your buy signal for yourself will be, and to, again, review the buy signal that we have for our trading plan. But before we get started, as always, remind everybody our presentation today is for educational purposes. Um, there's the stocks we look at today, the strategies we talk about are not meant to be recommendations. We're going to be using the paper money platform on Thinkorswim, and there's some uh, differences between that and your real account. We'll be talking about stop order as always. There's no guarantee that an execution of a stop order will be at or near the stop price. And as always, investing involves risk, including loss of principal, and past performance does not guarantee future results. So, uh, here's our lesson series. We're on lesson number 6 today, when to buy, an introduction to technical analysis. Our agenda is going to be to talk briefly about the tenets or beliefs behind technical analysis, go over some candlestick basics, take a look at some technical analysis concepts. We'll review that different types of buy signals, and then we'll go look at a stock on a chart and look at some support and resistance and buy signals on that as well. So we've got a lot to cover today. So let's go ahead and jump right in. If you have some questions, feel free to chat those into Brent. He's an expert in technical analysis, can handle all the questions that you have, and that'll be useful. But technical analysis is the study of historical price and volume to decide if there's a trend present. We'll talk about trends a little bit. Fundamental analysis that we covered last week is just analyzing a company's financial statements, balance sheet, income statements, looking for value and potential growth, those sort of things. The tenets behind technical analysis is that number one, prices move in trends, and that could be up, down, or sideways. Put this down in your notes. Trends tend to last longer than we think they will, whether that's an uptrend or a downtrend or a sideways trend. One of the things that I've seen over the years of doing this and working with hundreds and hundreds of people at this point, even thousands, is that the trends last longer than we think they will. Particularly the uptrends. Um, the second tenet that's important to understand is the market discounts everything. The current price of a stock represents all the collective market knowledge out there. One of the ways I think about this is that anything and everything that can affect the price is already doing so, and we see it reflected on the charts. The other thing is that history repeats itself or looks similar. Now, this is almost in contrast to past performance does not guarantee future results. And there's a word in there that's important, guarantee. But with history repeating itself, what we really mean there is that we humans tend to react similarly to price today as we did 10 years ago, as we did 50 years ago, as we did 100 years ago. It does not imply or past performance is a guarantee of future results or investing success, but it gives us a framework within which to operate so that when something deviates from that framework, we can take action. And that's, I think, something that's important to understand with technical analysis. It's not predicting the future. It's just giving us an opportunity to look like, if this happens, then what am I going to do? Or if this happens or that happens, right? What am I going to do? If it works for me, how am I going to react, or where are my exit points and what am I looking for? And if it doesn't work for me, I have a plan to kind of take care of that as well, right? All right, so those are the main tenets of technical analysis. You can think about those in your time, and hopefully some point down the road you start dreaming about charts and things like Brent and I do. All right. Now let's get into candlestick basics. I like candlesticks. This is not the only way to represent price. You can have a bar chart, you can have a line chart, lots of different ways to display the price action on a chart. Most of what you'll see from us at Schwab is that we'll be showing a candlestick chart. And the way the candlestick works is there's that rectangle, we call that a body. That shows the relationship between the open and the close. Above the body, we have a wick, and below the body, we have a wick. Sometimes you'll hear those called shadows or wicks, and those represent the high and low for the day. And then the way the candles set up is you could have like green and red candles or black and white candles or whatever color combination you prefer. But generally speaking, on our charts, if you see a white or green candle or a clear body, that will show the relationship is that the open was below the close, or the close was higher than the open. So that would be like a bullish day. The stock went up and down, but at the end of the day, it closed higher than it opened, and that means essentially the buyers had more control that day than the sellers. If you get a black candle or a red candle, then basically it just flips that relationship that the open was above the close and the price bounced around up and down during the day. And at the end of the day, the stock closed below the open, and that indicates that the sellers were in control that day. All right. So there's just a brief review of candles. I posted earlier there at the top of the chat. If you scroll up, I posted a link to what we call the Trade Management Mini Series. It's not called that in the chat that I posted, but there's a link that Barb has done a lot of really good short videos on candlestick patterns. So if you want to watch that, you can go review those. And then also we have a whole bunch of YouTube shorts that are like literally 2 minutes long, where you can go learn about all sorts of different type of candle patterns. If you have just a couple minutes and want to gain some extra knowledge, you can go to our YouTube shorts and see that. All right. So take a look at that there. Let's go take a look now at some technical analysis concepts. We'll start off with trend. Now, technical analysis breaks down to basically trend, support and resistance, and then volume and indicators. That's kind of the hierarchy of the way we think of things. Trend being most important, support and resistance next, and then below those two, we have our candlestick patterns slash indicators and volume. Some people put a lot more weight on volume than they do the indicators. Some are vice versa. You'll just decide, as you learn more about technical analysis, you'll decide which ones, weigh more for you or come into contact more with you and can be most helpful for you. All right. So uptrend, very simple definitions, a series of higher highs and higher lows. You've probably heard that. If you're brand new, higher highs refers to higher high prices and higher low prices. So, as the stock moves around, it makes a high on the chart, starts to pull back a little bit and then rallies. And then when it goes above that high, now we know we have a new higher high. And then as it pulls back, we look for it to be a higher low. And that's one of the ways that we can know what has to happen over the next couple of weeks or days or whatever for the trend to continue, which is a cool concept. One of my favorite ones is, once I make a new high, I know what has to happen for the trend to be continuing, and it has to make a higher low. If it doesn't make a higher low, if it makes a similar low, then that trend is starting to change. And that's one of the things about technical analysis that we can start to see happening fairly early, when that new high or new low is made, yeah, we can determine whether that's higher or lower than the last one. A downtrend, on the other hand, just what it sounds like, lower lows and lower high prices. Sideways trend's really kind of a combination, and it's not just similar highs and similar lows. It's a kind of a combination that you'll see. Sometimes you'll get a higher high followed by a lower low, and then a lower high, but a higher low, and then maybe a higher high and then a lower low. So it's that break of the trend of the higher highs and higher lows, or the lower lows and lower highs. Once we start to see kind of highs and lows that are mixed or similar, and don't get too specific about that. If you have to squint too hard to see that it's a higher high or higher low, then I would say it's a similar high or similar low. All right, does that make sense? All right, let's take a look at the next one. Now, support and resistance, after we determine the trend, then what we want to look for is what we call support. Now, support, you think of that like a floor. It's an area under the current price activity where buying appears to overcome the selling pressure. So, when stocks are driven down in price, again, there's more selling pressure driving that price down, down, down. And if there's a point at which, or a price at which, it seems like that downward movement stops and it starts going back up again, we call that support. Now, resistance is like a ceiling. It's kind of the other thing. Resistance is an area above the current price where the selling pressure appears to come in. You've probably seen this many times where the stock will go up to a particular price and it struggles to get above that price. Well, as we see it pull away from those price areas, that starts to become resistance. Now, put this down in your notes. It's not here on the chart, but put this in your notes. The more touch points you get at a support or resistance level, the stronger that level tends to be. And the stronger those levels are, then we usually need a catalyst of some sort to push us above or below those areas. All right. Now, support and resistance can be horizontal, but it also can be diagonal. We'll call that a diagonal price channel, but it's bouncing off similar line of support or a similar line of resistance, and it's diagonal. So think about those as you look at your charts going forward. Where would you draw support or where would you draw resistance? All right, now couple key points to understand about support and resistance. This is a huge one. Make sure you have this in your notes. Support and resistance are areas, not specific price points. Old resistance levels, old support levels may become new resistance, and old resistance may become new support. We look for that to happen on this graph. You can kind of see that we had some resistance on the left side of the graphic here, and when it broke out, a breakout, put this in your notes as well. A breakout is a close above resistance. When it closed above that resistance, it went up a little bit and then came back and tested that area of old resistance as new support, and it did it a couple of times, and then it had some resistance again, and it broke out above that. Okay, so those are the things that will help you. And then note, the more recent, or the more, this is kind of the way I like to say it, the more recent, the more relevant. Okay, uh, so maybe 14 years ago a stock had some trouble getting over $100. Well, that's probably an old resistance level, but the more recent, the more relevant those areas are. But that being said, is you want to be aware of where those areas are, because it could be. And that's, again, the whole point of technical analysis. It just gets us better prepared for what may happen. I think one of the things that makes trading and investing difficult is that uncertainty principle. So if we can add some clarity into our forecast, or if we can add some ideas or areas to watch for, then we're not surprised. Oh, the stock hit 100 and came back down. Okay, I can handle that. I can deal with that. But one of the things that was really challenging for me when I started is, I knew it wasn't possible, but I sure wanted every day to be a bullish day. And I wanted to buy the stock at 100, and every day it was 100, 101, 102, 103, 110, 112. It just never came down. And that fact that it did come down stressed me out when I first started. It was a hard thing for me to deal with. And then I finally learned that trend means higher highs and higher lows. And in order to get a higher low, you have to have some breathing out. The stock takes a breath in and then it breathes out, and that's that up and down price action. All right. Now it does look like there's a survey in the link there in the chat that's been put in there. If you take a moment, that you can do that after class, or it's a really quick, two quick questions, and then there's some fields to, say hello to me. I read these every day, or you can, what I really want to know is what things I can help you with. How can I help you be a better investor, be a better trader, be a better uh, position size person, with your positions and help you overcome some of your challenges and fears that you have. But, if you'll take time to fill that out, I do take time to read all of those. So, and I appreciate the notes that I know some of you send me individually. So appreciate that. All right, let's go on to the next concept. Now, indicators, these are very, very common. There's a lot of different types of indicators. Thinkorswim has literally dozens and dozens and dozens. There might even be more than 200. I don't remember at last count, but there's a whole bunch of indicators available to us. Now, basically, they fall into two categories, maybe three, because there's volume-based ones as well. But there's trend indicators, and probably the most common are moving averages. Trend indicators are typically laid or put directly on the price action. This chart that I'm showing here is actually a bar chart as opposed to a candle chart. But this bluish line right there, that's a moving average. And it tries to smooth out the price activity a little bit. And those can be very, very helpful. Some common time frames that people look at are 20 period moving average, 50 period moving average, and a 200 day. Those are probably the three most popular ones. You'll see a variety of different moving averages as you go to the different webcasts that we teach, but a 10 period moving average is quite common. 30 period, you'll see that fairly frequently as well. All right. Oscillating indicators, on the other hand, tend to be shown on a chart below the price action in their own little window. And oscillating indicators typically help us see, momentum. They help us see sentiment, like is this overbought or oversold? And there's a variety of different indicators that do that. All right. So those are some things about the indicators on a chart. Technicians often look for one or more indicators to confirm price action. And I think that's important to understand is the price is what moves the indicators. The indicators don't move the price. Okay, let me say that again. Price action moves the indicators, not the other way around. All right. So, that's we oftentimes will look at those for confirmation. We might see a bounce off support or the moving average here, which we'll talk about in a second. But we'd like to see the indicator like rolling up or going up when that bullish price action starts to go up. All right. Now, volume, like I said, this is another group there in that indicators and trending indicators, oscillators, volume, candlestick patterns. Some people weigh those the same as far as the importance of that when they're looking at technical analysis. But the volume chart is often positioned below the price action as well. Now, here's a couple important points with volume that are really, really fun to see on the charts. For bullish positions, investors like to see higher volume on the days where the price is rising and lower volume on the days when it's down. Now, when that first transitions, generally you'll see a spike in volume, like when it changes from bullish to bearish or bearish to bullish, you'll see a little bit of a spike. And then, like in an uptrending stock that's making higher highs and higher high prices, as the stock starts to go down, we would actually like to see that volume start to decrease as it gets down near a support level, right? So, if the price is coming down and the volumes, like in this little chart, looks like it's remaining fairly steady, that's not the ideal scenario. The ideal scenario would be as the price comes down and gets near the moving average or near an old resistance level that we might expect to be new support. As it gets down near there, we like to see the volume start to dry up. And that's usually an indication that the support level will hold. If the volume tends to be rising, going down, every day it's getting bigger and bigger and bigger as it goes down near what we think the support level is, there's a chance that that support won't hold because the volume's high. So those are some things to think about when you're looking at that volume. there. And one of the things we do like to see is if there's a break of resistance, we like to see that happen on bigger volume, especially for a bullish entry signal. And then some people will set lower limits for volume to determine the liquidity or the ease at which they can buy and sell the stock at the prices that are being quoted. All right, let's see here. Just taking a peek. I don't see any questions that have come through. Brent's doing a good job there to help amplify our discussion here. All right, let's take a look now. This part, this is if you're doing dishes or whatever, this is where I want you to stop doing the dishes, stop watching, the other channel. Pay attention here because what the takeaway I want you to get from here is what is your buy signal? Will and Sharon and Simone and everybody else that's here, what is your buy signal? When we talk about a bullish bounce, what exactly is going to cause you to take action? And don't think of it necessarily as a buy signal as much as an action symbol or a signal. What's going to cause me to take action? Now, first we have to define what a bullish bounce is. And we define this as a close above the high of the low day. You've probably heard some of the coaches or instructors talk about hold, close above the high of the low day. That's just how we define a bullish bounce. Now, that may or may not be your personal entry signal. So I want to talk about that for a minute. Okay. Now, let's define the components of the hold or the close above the high of the low day. What is the low day? Now, again, this is, not necessarily the only way to define this. Some people have, red candle, low candle, doesn't matter. But the day in the pullback that has the lowest low price. So in the little graphic over here, we have three black or downward candles, and obviously the one on the far right here has the lowest intraday low, the wicks lower than it was the previous day. So we would call that the low day. Now, some people will say, well, that's only a low day if it's a, red candle or a black candle. For me personally, I don't care what color it is. I'm looking specifically at that low for the day. If that happens to be a green candle, but it has a lower low than the day before, I'll call that the low day. All right. Does that make sense? All right. So there's the low of the low day. What's the high of the low day? Well, the high of the low day is just what it sounds like. Whatever that high was, let's just say for argument's sake, it's at $50. All right. That's the high of the low day is at $50. Now, the close, to define that as a bounce, we're looking for a close above the high of the low day. So if we go back a second here on the graphic, if this is at $50, then what would constitute a bounce? Now, I want you to think about this for a second, okay? Because a bounce, by definition, is a close above the high of the low day. So technically, if that's at $50 and it closed at 50.01, then it would be a close, right? Or another way to think about it is that close is sometimes that last 30 minutes of the trading day. Maybe it's the last 15 minutes of the trading day for you. But here's what I want you to take away here. What would cause you to take action? And I see Sharon's got hold, the TA, trade above the high of the low day. So, when we're looking at a bullish stock with an uptrend and we see maybe a moving average or an old support level there near the low of the low day, and we think to ourselves, wow, if that bounces, I want to buy it. Well, what's going to cause you to take action? Is it a trade above the high of the low day? And if so, by how much? Is it literally the close? So you're not going to really take action, period, until it's the last 3 or 4 minutes of the day, and you can see that it's closing above the high of the low day. And, so put this in your notes. The shorter your time frame, the shorter type of trade you're doing, the more important that entry signal becomes. Because, usually in a short-term trade, you're going to not only have a downside exit if the stock moves against you, but you're also going to have an upside target in mind, and you may not be able to afford to wait until the end of the day because you may miss a big chunk of your potential move. Okay. Now, for our in class, we're doing investing plans, right? We're doing longer term trades. So whether I buy the stock at $50.50 or $51 or 50 $52 or 51.80 probably doesn't matter as much in the longer term because we don't have an upside target. We're just trying to ride the trend. All right. So, but that's how we define a bullish bounce. And we talk a little bit now about you personally, Will, Simone, Sharon, Eva, Jenny, everybody else that's here, Gary, and everybody else that's watching today. Um, Decide for yourself what's going to cause you to take action, and then try to do that entry signal exactly the same way for the next 10 practice trades in your paper money account. Is just develop that discipline, develop that way of thinking and that process to help you become very consistent in how you trade. All right, let's take a look at breakouts. A breakout is by definition a close above resistance. Now, again, you'll have to decide what your personal breakout entry trigger is. Is it literally that close during that last 3 minutes or 4 minutes or 30 minutes? What exactly does that mean for you? Or is it just a trade above resistance? How many of you have seen a stock, that has a resistance level? It's been struggling to get above, let's say, $100. And when it finally does, it ends up going up like $6 when it breaks out. And you think, dang it! At the end of the day, you missed your entry signal, right? And so, if you look at a lot of stuff that James Boyd does, Brent will talk about this in his webcast, is a buy stop. We've done a few of those in our class as well. But a buy stop is the type of order that you might say that, hey, if this trades above resistance by some amount, stop me in instead of stop me out. And it's kind of an interesting way to try to catch that momentum when it breaks resistance. And then obviously we hope the stock, goes well above our entry price at the end of the day. All right, so those are bullish breakout and bounce and breakout signals from a technical price action standpoint. There's other buy signals that we have as well that are based on the indicator. So look for that. This is just a note. Some traders, investors will look for multiple closes above resistance. That's pretty common. Or a close above by a certain percentage is their entry trigger. Nothing wrong with that. Again, I think, the longer time frame that your horizon is, probably the less important the timing is. But if you're doing a price pattern breakout trade where you have a target in mind, there's a point at which it doesn't make sense to take that short-term trade anymore because you've missed too much of the move. All right, so consider that there. All right, now, if we're using indicators as a buy signal, buy signals are usually based when price closes above the moving average. That's going to generate what we call a green arrow. I'll show you this on a chart here in a second. And so, those might happen when the stock's been below the moving average and it closes above. That's what generates a buy signal. All right. The other buy signal is when it bounces off of that moving average. That would be a bounce that close above the high of the low day type of idea. All right. Those are, one way to think of a moving average buy signal. If you're looking at the oscillator, most oscillators have a range or an area above and below, which is their signal line. The MACD histogram that is on this graphic, when it crosses above the 0 line, that's going to generate a green arrow. And when it crosses below that signal line, it'll generate a red arrow. But those are also considered buy signals based on the indicator. Now, you may have a different way again of identifying your buy signal, and we'll talk about the indicator one here in just a minute when we look at a chart in more detail. But again, the big takeaway that I want for you today is that you just decide, what's going to cause me to take action? What's going to be my bullish buy signal? What's my bounce buy signal? What's my breakout buy signal? What is my indicator-based buy signal if you want to use indicators? Because without that knowledge, what happens is that you will see, hey, that looks like maybe a valid buy signal, but you're not dialed in or you're not convinced that works for you. What happens is we hesitate. We won't take action. And if you're like I was when I first started, I would see a buy signal, but again, I didn't have that conviction that that was my buy signal. I hadn't decided what my buy signal was. So I'd see a buy signal, I think, oh, I'll wait for some extra confirmation. And then another day would happen and it's up a little bit more. And it's like, oh, no, I think I'll wait for extra confirmation. And then the third day, that's inevitably the day the stock would take off. And I'm like, ah, now I've missed the entry signal, and I wouldn't take action. It was very frustrating. So please, decide today what your buy signal is. And here's a key. Here's a secret. You can change it. So just pick something and then trade that 10 times in your paper money account. And if it doesn't work for you, then now you have some experience. You can say, you know what, I don't like waiting for the close. I missed too many dollars of movement. Or maybe you're getting in early and you think, you know what, I get suckered into these trades. It looks like it's breaking out, but then it doesn't. So I'm going to wait for the close. But you can't know that for yourself until you've done some examples. So go out and practice something for 10 trades and then come back and evaluate. Do you like what you were doing? If not, modify it a little bit. Then guess what? Do 10 more trades. Go do 10 more trades and practice that signal until you know what's like, I like this one. I can trade this one consistently. And recognize that not every buy signal is going to be a winning trade. It's just that's, in my experience, impossible. I don't like to use impossible or always in the markets, but there is no perfect buy signal. So, you just get to pick something that you get to work with and that works for you. All right. So hopefully that's helpful. I'll get off my soapbox. All right. Now, traders and investors often use multiple indicators to confirm an entry signal. Now, here's my rule of thumb, everybody. Here's my rule of thumb. Do not have an indicator on your chart that is not directly related to your buy signal or exit signal. Because what starts to happen is it's really easy to get too many indicators on a chart. And then you never get any buy signals. So again, find that balance. In our little sample trading plan, we're essentially using two indicators, a 50 period moving average and a MACD histogram. Now we do have a moving average envelope on our chart, and we use that specifically for our exit. So, I'm following my own rule there because I think it's really easy to get too much on your charts. All right. Now, again, past performance is no guarantee of future success, and this is just for illustration purposes. All right. Now let's go look at an example. Got a little bit of time left. Let me go to my Thinkorswim platform, and I want to just, again, talk about this. Again, remember, there is a survey there. If you get a chance to fill that out, we appreciate it. So on this chart, we have a green line. Okay, the green line on this chart is our moving average. Let me change my drawing tool here to be an arrow so we can see it. But the green line right here is a 50 period simple moving average. It's a trending indicator. It's a moving average like we talked about. The little dashed purple line is what we call a moving average envelope, and it's literally just 1% below the 50 period moving average. So that just tells us, instantly where our stop should go based on our rules for our sample plan. All right. We have a MACD histogram over here. It's based on these different moving averages. The default for your MACD histogram in the Thinkorswim platform is actually 12.26.9. I learned it as 8.17.9, a little bit faster reaction than the 12.26.9. Nothing inherently special about that. It's just what I learned, and so that's the one I use. But you can change those when you load up your system. And in the description of this webcast, there's this chart. I've shared the chart there. You can grab the little code to get it there. But if you want to load that chart up, you certainly can. Now, I just want to point out a few things here. Very first thing I want to do is actually just place this buy order so we can make sure it gets done before we run out of time. But right click, buy custom with stop, and we're just going to walk through this kind of together. So very first thing is do we have a valid buy signal? Now, this is the buy signal for our sample plan that we went over in lesson 4 a couple weeks ago. But our buy signal is this. We have to have 2 green arrows. Okay, so 2 green arrows, and the green line, the moving average, has to be rising. It's possible, like we got over here, we had a green arrow, and we had a green arrow on the MACD, right? But the moving average was falling. Okay, if the moving average is falling, that means the intermediate trend basically is down, and we're not buying downtrending stocks. We're trying to buy stocks that are already uptrending or that are starting to uptrend. Okay, so right now, the question is, do we have two green arrows? Well, if the price is above the moving average, then it's a green arrow. But that actually happened here this day on the 15th of July. That was the green arrow day. Now, why was that a green arrow day? Well, to get a green arrow, the stock price has to close above that moving average. The day before, you can see it closed below the moving average, and that's what generates the red arrow. All right. Now put this in your notes there somewhere, especially if you're new. All right. Is the green arrow is green until it turns red. So like this green arrow was green all the way until it turned red over here. This green arrow that happened on the 15th of July is still green. Okay, even though it's been 1, 2, 3, 4, 5, 6 days. Now I see a question from Barbara. She says, how did you determine or choose the 50-day moving average for this strategy? That's a great question. So one of the reasons I chose the 50 period moving average is because it's a very popular intermediate to longer term moving average. So, the original objective of our investing plan, Barbara, was to buy stocks that are uptrending and that were part of the S&P 500, that were already big companies, that were already mostly fundamentally sound companies that were there trading. And so, I wanted to have a little bit longer term type of moving average, like a 50 period versus like a 20 period or a 30 period moving average, just to try to allow us to stay in that intermediate to hopefully longer term trend. And the longer moving averages allow some wiggle room for that to happen. If I'm trading like a 10-day moving average, for example, you're going to get the stock closing above and below, above and below, above and below, and you're getting a lot of different signals. And I wanted to eliminate a lot of that noise to try to allow us to do an intermediate to longer term type of trade. So that's a great question. All right. Let's see. So we're talking about green arrows. Green arrows are green until they turn red. The MACD is green, and that turned green here on the 17th. So you'll notice that those don't have to be on the same day necessarily, but we just want them to be this current reality or the current status is that both of those are green. All right. Now, in this case, the last little component for our valid buy signal is two green arrows and that moving average is rising. Now, if I put my cursor on the moving average, you can go up right here and see the value. Like that day, it's at 91.22. If I put it over here and you look at that same spot, it says 90.54. Day before 90.22, day before 89.97. So, if you couldn't visually see that those were rising, you can actually look at the values and determine whether it's rising. All right. So we do have a valid buy signal here. So let's go ahead and place a trade on this. And then I want to talk about this a little bit more technically, just because that's our topic today. All right. So I'm going to right click here about the close, buy custom with stop. And the moving average again, or the envelope says our stop should be at 89.64. So we're just going to unlink that, say make a manual stop at 89.54, was it? Let's double check that. Yeah. Oh, 89.64. And we want the stop order to be good till canceled. And our buy order, we're just going to put a buy at the closing price of 157. So that's going to be a little different than the current quote that came up. And I like to make that good till canceled as well. All right. I do see your question there, Alejandro, or sorry, Alejandra. Let me get through this example, then I'll come back and answer that. All right. So there's our order to buy. Now, if you were here in our lesson 4, you learned that we're allocating about $500 maximum to our positions in our getting started $10,000 portfolio. So we're going to go in there with 4 shares and we're going to lock that link up. So we're going to buy 4 and sell 4. And then now we have our order. So let's hit confirm and send. And it's not send and send, it's confirm and send. So buy 4 at 1,057 limit, sell for 89.64 is a stop order. No guarantee we get filled at 89.64. That's going to trigger a market order, and then it gets filled at the next available price, which could be significantly lower than 89.64. It could gap over that. So just be aware of how that works. And we have a 2 green arrow group, so we're going to put this in our 2 green arrow group. and send that off. All right, so there's our order pending. Now the question that came up is not sure if I heard correctly, but Scott said he posted the link to have the chart so we could add it to our Thinkorswim. If that's the case, where can I find that? Uh, it is in the description of this webcast there, Alejandra. You can go down there. But I'll go ahead and I can share it up here as well. So we'll call this two green arrows. Now this code's going to be a little different than the one in the description because I'm generating it right now. And so here's that two green arrows. And just realize that these are what's called a script, and they aren't guaranteed for price, time, or accuracy. So just be aware of that. All right. Now, from a technical standpoint, as we have just a couple minutes, I want to point out number one is that this high, 102.46, is higher than our last high. And I like to draw little circles when I first started. I like to draw little circles on my, or actually little rectangles. I draw a little rectangle on my last high. Here's my last low. And now here's my current high right up here. Now, how do I know that that's a high? Well, remember our definition of a bullish bounce? The way we define a low in the trend is when we get that close above the high of the low day. So like if this is our low day over here and we got a close above that, then we can draw that as a low. We made a little high up here, but how do we know that was a high? Well, the next day it closed below the low of the high day. So as the stock rallied up, it closed below the low of the high day and it made a low right there. How do we know that? Well, that's the low day in the pullback. And then right here on the green candle, it closed above the high of that low day. It traded above it here on this candle, but it closed above it here on the 2nd of July. Then we ran up for a few days. We made a high up here. How do we know that's the high? Because it closed below the low of the high day that next day. And we pulled back, pulled back, pulled back all the way to earnings. Then we gapped up. This candle here, the big gap up candle, closed above the high of the low day. And so you can kind of see how those short-term highs and lows play out. And like right now, I know I have a higher high and I need to get a higher low, but I don't know where my low is yet. So the stock could come down a few more days. Now put this in your notes as we wrap up. Okay. The low of a gap up day right here. The low of a gap up day, that tends to be a potential support and resistance level. All right. Now that one kind of coincides nicely with this high. So that would be an area that some technicians would watch. Halfway through a big candle, okay, halfway through a big candle, that's a potential support and resistance level. So just kind of keep an eye on that. All right. And one other, this little example here, we had some resistance in this neighborhood. And resistance is an area, not a specific price. But you can kind of see that old resistance there became new support, bounced off of that, kind of did a deep test of what I like to call it when it closes below that, but then bounces off of that. And then we have some support in this neighborhood here. All right. So hopefully that was helpful for you today, everybody. Again, take a moment to fill out that survey, if you will. We went over some technical analysis tenets. We went over candlesticks. We talked about support and resistance and trend indicators and oscillating indicators. We looked at a buy signal for breakouts and bounces. And your homework really is just to decide what your buy signal is that you're going to test perfectly for the next 10 paper trades, practice trades. All right. So do that. Have a great day, and we'll see you next time, everybody.